Alright, welcome to the CFO channel. My name is Ali and I simplify accounting and finance concepts. In this video, we'll go over a simple explanation of what depreciation is. The way to think about depreciation is that it is the accounting equivalent of wear and tear. Whenever you buy a car, there's a common saying, as soon as you drive the car away from the dealer's parking lot, the car loses 15% of its value. I don't know who came up with this saying, but it is a saying. That decrease in value is what accountants would refer to as depreciation. Now, in general, depreciation is related to capital assets. Now, you might be asking yourself, what's a capital asset? A capital asset is basically any type of property or equipment that you've purchased that you can use over time. This includes things like a car, a building, a computer, office equipment, etc., etc. Now, when it comes to capital assets that are purchased by a company, these assets sit on the company's balance sheet. This is because the assets will last a while and they'll provide the business some benefit over a certain period of time. That benefit is usually related to the income you can generate from those assets. Now, once the asset has been capitalized, and let's say that asset is some sort of a car, for accounting purposes, you do need to show some wear and tear on that particular asset, and that is usually done through depreciation. Depreciation is usually recorded as an expense on a company's income statement or profit and loss statement. Now, once you've recorded depreciation on the income statement, you also need to record that depreciation on the balance sheet in an account called accumulated depreciation. The simple way to understand what accumulated depreciation is that it is an account that holds all of the depreciation you've recorded on a particular asset since you've bought it. So, whenever you're looking at the value of an asset on a company's balance sheet, it's usually calculated taking the asset's purchase cost minus all of its accumulated depreciation, and then you get something called net book value. Whenever you're looking at a company's balance sheet, that is exactly the number you're looking at. Now, if the concept of accumulated depreciation seems a little bit confusing, don't worry. In this video, we'll go over a couple of examples that will clarify how accumulated depreciation works. Now, when it comes to recording depreciation on a company's income statement, you can use two methods. The first method is called straight line amortization, and the second method is called the declining balance amortization. Straight line depreciation is pretty easy to understand. If accounting rules state that a car needs to be depreciated over a 5-year period, what you do is you take the car's value, divide it into 5, and that is the depreciation expense you will record on the income statement over a 5-year period. Let's take a look at an example and see how this works. Alright, so let's say that you decide to purchase a new car. The car will cost you $50,000 and you will depreciate it over a period of 5 years. So in year 1, you will take a depreciation expense of $50,000 divided by 5 years, so $10,000. Your accumulated depreciation will also go up by the $10,000. Net book value will be basically your cost of the car minus accumulated depreciation, so $50,000 less $10,000, which is $40,000, and that's the result in year 1. In year 2, you will do the same thing, take depreciation expense of $50,000 divided by 5 years, so $10,000. Accumulated depreciation here actually goes up by the $10,000 expense that you took in year 2. So that's the $10,000 you had in year 1 plus $10,000 you took in year 2, $20,000. And net book value here is $50,000 less accumulated depreciation of $20,000, which now brings you to $30,000. Now, the next method of depreciation we see quite often is something called declining balance. Declining balance is basically amortization calculated using a percentage. The way to calculate this is to basically take the asset value and multiply it by the prescribed percentage, and the result will be the depreciation expense you need to record. This method is slightly more complicated than the straight line method of amortization, so let's take a look at an example to understand how this works. Alright, so same example. Let's say you buy a car for $50,000. The depreciation rate under declining balance is 25%. In year 1, you will take a depreciation expense of $50,000 times 25%, so $12,500. Your accumulated depreciation will be $12,500. Your net book value, which is cost minus accumulated depreciation, will be $50,000 less the $12,500 of accumulated depreciation, which gives you $37,500. In year 2, you will take depreciation expense on the net book value of $37,500 at 25%, which is $9,375. Accumulated depreciation will go up to $21,875, increased by the depreciation expense you took in year 2. Your new net book value now will be the $50,000 of cost for the car minus accumulated depreciation to date, which is $21,875. So that gives you a new net book value of $28,125. Now, in terms of pros and cons between the two methods, number 1, the declining balance allows you to write off more of an asset in the early years, which decreases profit in the early years. And number 2, the straight line method of depreciation is more consistent because you take the same expense year over year. Another key difference is that the straight line method usually specifies how long you need to depreciate an asset for. It could be 5 years, 10 years, or maybe more. Now, the declining balance method doesn't specify a time period in which you need to record your depreciation. Just keep applying the percentage to the asset value. And because it's a percentage, the asset will never be completely written off just through depreciation. Now, generally speaking, most publicly traded companies use the straight line method for financial reporting purposes. However, the declining balance method is used for tax purposes. So I hope this video helped you understand what depreciation is and how it works. If you'd like to learn more about accrual accounting, check out my previous video here.